What am I reading?
Section 3. Or more sarcastically said, you're reading BPP. Go.
P-Tech Course 4 student outline Section 3 Ownership of Personal Property. Learning objectives. Identify ways that personal property can be owned. Identify the major forms of business structures. Know what kind of information may be available under each business structure that may aid in the discovery and valuation process. List the different levels of liability and the types of financial records to expect from the various ownership structures. This section discusses types of ownership, the importance of determining ownership, determining who owes taxes due, and collection efforts. Since the owner is responsible for taxes due, it is important to determine outright ownership or whether there is a lease, rental, loan, etc. A. How can personal property be owned? Number 1. Many types of personal property ownership do not include the entire bundle of rights. Appraisers must determine who actually retains the liability for property taxes. Number 2. Some of the common ways that personal property can be owned are leased to another person or operator of the equipment, loaned to someone that has possession and right to use, rented to a third party who will use it for a term, consigned to be sold by a third party, or owned outright. Number 3. Obviously, if the personal property is owned outright, it is simple to determine who is responsible for the taxes due. However, in other situations, we must determine who is the lessor or the rentor, or the renter is to determine who is actually responsible for the taxes due. This can be complicated by a lease agreement that states that the party leasing the personal property must reimburse or pay the taxes due. In these cases, even with the lease language, the owner is still the liable party. B. Why is the determination of ownership so important? Number 1. The importance of determining ownership is to ensure the proper party is subject to the taxes due. Collection efforts rely primarily on knowing who the correct owner is and can only be successful if the lawful owner is listed. Determining ownership is critical to the proper collection of taxes. C. Types of ownership. Number 1. There are some basic forms of types of ownership structure. Personal property can be owned by individuals, partners, or corporations. While those are general groupings, each of these categories has subgroups. Number 2, depending on the structure or form of ownership, we may have different expectations about the amount and quality of discoverable data. The potential liability for an owner varies depending on the form of ownership. D. Sole proprietorship or individual owner. Number 1. A sole proprietorship is a business owned solely by one individual or a married couple. Sole proprietorships are the most common form of business structure. This type of business is simple to form and operate and may enjoy greater flexibility of management and fewer legal controls. However, the business owner is personally liable for all debts and obligations incurred by the business, such as owner reports business income and losses on personal income tax. Owner is personally liable, unlimited, for obligations and judgments. Records can be very thorough or limited. Sometimes hard to determine personal assets from business assets. Personal property can be highly mobile, high use of doing business as DBAs, and difficult to track. E. Partnerships. A general partnership is composed of two or more persons, usually not married, who agree to contribute money, labor, and/or skill to a business. Each partner shares the profits, losses, and management of the business, and each partner is personally and equally liable for debts of the partnership. Formal terms of the partnership are usually contained in a written partnership agreement. Number 2, A limited partnership is composed of one or more general partners and one or more limited partners. The general partners manage the business and share fully in its profit and losses. Limited partners share in the profits of the business, but their losses are limited to the extent of their investment. Limited partners are usually not involved in the day-to-day operations of the business. Number 3, a limited liability partnership is similar to a general partnership, except that normally a partner does not have personal liability for the negligence of another partner. This business structure is used most commonly by professionals such as accountants and lawyers. Number 4, the limited liability company is formed by one or more individuals or entities through a special written agreement. The agreement details the organization of the LLC, including provisions for management, assignability of interest, and distribution of profits or losses. Limited liability companies are permitted to engage in any lawful, for-profit business or activity other than banking or insurance. LLCs have many of the benefits that a corporation enjoys, but they are not considered separate legal entities, and owners pay taxes on business earnings through their personal income tax. Such as, owners report business and income and losses on partnership's return. Owners share liability, limited, for obligations and judgments. Records can be very thorough or limited. It's a wide range. Property is generally held in name of partnership. Sometimes owners maintain ownership of assets and lease to partnerships, and high use of DBAs. Number 5, sole proprietorships and partnerships make sense in a business where personal liability is not a concern. An example is a small service business in which you are unlikely to be sued, for which you will not borrow much money for inventory or other costs. F, corporations. Number 1, a corporation is a legal entity with certain rights, privileges, and liabilities beyond those of an individual. Doing business as a corporation may yield tax or financial benefits, but these can be offset by other considerations, such as decreased personal control. Corporations may be formed for profit or non-profit purposes. Typically, corporations have multiple shareholders and are required to file various documents and reports with the Securities and Exchange Commission, the SEC. Number 2, C corporations and S corporations. A C corporation is a taxable entity and what we usually think of when we think of a corporation. It is the type of corporation described in the previous paragraph. Typically, C corporations are publicly traded and have many unrelated owners. A C corporation is required to file documents with the SEC, and that information becomes public. An S corporation is owned by less than 100 individuals and sometimes limited to family members only. Also known as a closely held company. Its record keeping is similar to a partnership, and information is typically not available to the general public. A non-profit corporation is a legal entity operated to further an ideal or goal rather than for profit. Many non-profit corporations serve the public interest, but some do engage in private sector activities. Number 3, review of corporations as a whole. Legal entity with shareholders as owners. The corporation is considered the owner, limited liability for shareholders. Audited financial records filed with the SEC. Records are kept on a book basis rather than a market value tax basis. And S corporations are similar to a partnership and not publicly traded. G, other forms of ownership. Number 1, cooperatives or a co-op. Some people dream of forming a business of true equals, an organization owned and operated democratically by its members. These grassroots business organizers often refer to their business as a group, collective, or co-op, but these are often informal rather than legal labels. For example, a consumer co-op would be formed to run a food store, a bookstore, or any other retail business. A workers' co-op could be created to manufacture and sell arts and crafts. Number 2, voluntary associations. A voluntary association or union, sometimes called a voluntary organization, unincorporated association, or just an association, is a group of individuals who enter into an agreement as volunteers to form an organization to accomplish a purpose. In many such organizations, only the registered association is considered a legal person, and the members are not responsible for the financial acts of the association. Most associations have documentation that regulates the way in which the body meets and operates, and that is often referred to as the bylaws, regulations, or agreement of the association. H, in summary, ownership is the key to knowing who is liable for taxes. Understanding how personal property can be owned and understanding the types of business organizations are critical to accurately valuing property and assigning it to the correct owner for collection of taxes due. Sole proprietorship, partnership, and corporations are the most common types of business organizations. Liability for debts and taxes is highest for a sole proprietorship and lowest for a shareholder in a corporation.